Hey guys, tax attorney Joshua Sells here. Hey, another daily tax update for the Tax Law Guy video channel. Hey, today I wanted to talk briefly about cryptocurrency, virtual currency, and this is not by any stretch of the imagination an exhaustive guide for the taxability of cryptocurrency, but we do get this question quite a bit, and that's, if I can read it specifically here, tax on crypto transfer. So we had a question come in the other day. Somebody was asking us about a cryptocurrency transfer, whether that was taxable. And so I wanted to talk about that briefly because there's a little bit of a disconnect with some of our viewers about what a transfer is and what an exchange is. So a transfer is when you transfer from one wallet to another. Okay, and the equivalent would be you switch. As an example, a bank, right? You take your funds from one bank, put it in another bank. So you're going from one wallet to another wallet. Your actual virtual currency is not changing, or is not exchanging, as we'll talk about in a moment, but you're just going from one wallet to another. That is not a taxable event, okay? So it would be no different than if you had a 401k with Charles Schwab and you were going to transfer to a 401k with Morgan Stanley, for example. So it's a non-taxable event. So transferring from one wallet to another is not a reportable or taxable event. Again, there would be an information return generated by the wallet, but again, that's not something that there will be tax on. The other aspect is the exchange, and so that's where if you take one type of cryptocurrency, virtual currency, and you exchange it for another, that is a taxable event. So if you, for example, have Bitcoin and you exchange it for Dogecoin, absolutely, that's no different than a sale. You for all intents and purposes, you sold and then you bought another cryptocurrency. That is a taxable event. Be very careful about that because we have a lot of clients that get themselves into trouble because they just float around the different currencies, not realizing the impact every time they sell that. That is a taxable event. Now, you may not have a significant gain, but you do have to tell the IRS on your return what the basis was of that purchase that you sold or exchanged, so that there is not tax on it. Hey, most important thing you can do at the end of the year is to report all of those transactions because they are now being reported to the IRS. If you don't include those, they're going to assume that it was all gain and there is no basis or cost, which we know that's not correct at all. So don't be afraid about reporting virtual currency on your tax return. They already know about it. Gone are the days of this of cryptocurrency and virtual currency not being visible to the IRS. Those days are gone. They absolutely are aware of it. And so if you exchange your cryptocurrency frequently, make sure you keep records of that. That way at tax time you can report that if there was a gain on it. So again, today we're just briefly talking about the difference in a transfer and an exchange. That transfer from one wallet to another wallet is not a taxable event, but an exchange absolutely is a taxable event. Okay, if you have any questions about virtual currency, the taxability on it, please drop a comment below. We'll take a look at that and definitely get back to you. This is a complicated area of tax law for sure, but at the end of the day, it's just like any other asset. If you sell or exchange it for more than what you purchased it for, there is a taxable gain on there, and the character of that gain is determined based on how long you held the asset, whether it's long-term or short-term. We'll have more videos on that in the future, but for today, just a brief discussion on the difference between an exchange and a transfer. All right, hey, thanks for watching Tax Law Guy today. We'll see you tomorrow.